Yeah, morning to you all. Yeah, not so good actually. Bit wet around here, but yeah, sort of. We're in interesting times, aren't we? You think by looking at the S&P 500, the very broad and closely watched stock index in the US, which really represents a US PLC, as it were, we've pretty much taken out the highs. It's extraordinary. You wouldn't think there was an escalating war in the Middle East that could, I don't know, Israel, what are they going to retaliate? Where are they going to do it? They're going to do something. And these THAAD missile systems that have been delivered to Israel suggest something is in the offing. And yet stock markets, I mean, it wasn't a particularly exciting week last week. Just looking at what's going on here, it sort of dribbled higher. We had slightly worse than expected inflation data last week. US CPI, where is it? So there we go. So the core rate was a little bit stronger than expected, plus 0.2, and the headline rate was a little bit above expectation as well. Still better than the previous month. So it's still keeping us on track, or keeping the Federal Reserve on track to cut interest rates at its next meeting on November the 7th, as you can see here. So there's an 88.6% probability of a cut. Anyway, Chinese markets were actually pretty volatile. I'll get onto them in a second. But equity markets really across the board, apart from UK, actually, the only market that really didn't get into positive territory was the FTSE. But it really is. I mean, just look at that. I mean, that sums up what's happening. Yes, it's going nowhere. Lots of wicks, lots of rejection of the downside, lots of rejection of the upside. That's because we're all waiting for this ghastly budget on the 30th of October. And it was interesting. I was listening to Radio 4. I probably mentioned it last week. God, I hate to think I did. But Alistair Campbell was on, and he said it's unusual to have a budget 16 weeks after a new government is formed. Normally they happen quite quickly, like the one in 2010, Blair's new government in 1997. They had a budget within 6 weeks. So it's got this sort of like, oh, what are they going to do? And this is summed up in this market here. Yeah. So, but anyway, in the US, slightly more different, as you can see, just looking at the S&P 500. 3 weeks, yeah, just over 3 weeks to go until the US presidential election. Results far too close to call. I know you'll probably realize or have heard that it's all down to the 7 swing states. The rest of the states, we all know what's going to happen, but it's those ones that are very, very close to call, too close to call, that could swing the election either way. And that is something that was to Trump's benefit in 2016. He actually got fewer votes than Hillary Clinton, but he still won, and then complained in 2020 when the opposite happened. Anyway, the media is full of views about what will happen if each candidate gets in, but it's just so uncertain that I don't think the markets can react to be honest. I mean, they're reacting to positive news generally about interest rates and about a very strong unemployment report or employment report we got at the beginning of the month, and that still percolates through the market. But yeah, it's difficult to know what to do ahead of the election, because if Trump gets in, his advisors are trying to say, no, all these tariffs won't lead to a weaker dollar. They will. They would definitely do that. And if you say it often enough that it won't, then it will just appeal to Trump supporters. At least they'll be, mollified by it. Anyway, last week's inflation data, yeah, as I say, it was pretty much, it showed another decline. It was the 6th monthly consecutive fall in inflation in the US, but the prints were slightly worse than expected, as I say, but it hasn't really changed things. When you look at the odds of an interest rate cut, it is now an absolute shoo-in that it's going to be a 25 basis point cut or a quarter point cut. It went to about 90% last week, but it's drifted a little bit to 88.6. But really anything above 75, 80 is pretty much odds on. And odds on for another, well, not quite so strong for actually, yeah, for another quarter point cut in the December meeting. So 2 further quarter point cuts by year end. That's what we're looking at here. Chinese markets, I like to, it's worth discussing these because China is the second largest economy in the world. And what happens in China does affect us. It really does. If you look at what's happened with the Hang Seng, these are huge, huge moves. This move here that culminated on the high on the 7th of October, was it 7th of October? That was a Sunday, wasn't it? Oh no, Monday. The 7th of October. Since then, there's been some pretty horrendous moves. That following Monday was huge. There's like a 13% fall on the Hang Seng. But this is it's dragged in vast hordes of retail investors who've piled into equities. A lot have been burnt, and at some point it actually pushed the Hang Seng into the top performing international index this year, which is extraordinary. I mean, it really is, bearing in mind it was way down. Anyway, it's not the top performing index anymore, but over the weekend, Beijing announced further plans to increase spending. I suppose really one of their things they've got to do is to try and alleviate the sort of debt-ridden property sector of its problems. But many analysts, I think, had expected more detail about how much would be spent over the weekend, and I think, and where basically. And I think the problem for many investors that jumped onto the bandwagon is that all the good news and more has been discounted. So, and I think one of Beijing's problems, which is highlighted by this data that came out this on Sunday, yeah, they do release data on Sunday, is the deflationary pressures are plaguing the Chinese economy. What do I mean by deflation? Deflation is where prices are falling. And you'll look at this and think, no, Joe, that's plus 0.4, that's rising. But if you look at this little graph here, you can see that prices in the fourth quarter last year and in January this year were falling and falling quite dramatically. That's not good for any economy and not good for the world's second largest economy. So that's their problem. And I think the PPI data, which is even worse for the Chinese economy, that's still negative 2.8. It fell even further. What PPI is, or producer price index, it is the costs of goods and services going into production, sometimes referred as factory gate prices. And that sort of implies that there is waning future price pressures as well. So that doesn't look good for future inflation. And you might think, hang on a second, I thought inflation wasn't good. We don't like inflation. No, we do like inflation. We like 2% inflation. We like targeted inflation. We don't like 11.1% inflation, and we don't like deflation. But if you're running a business, you want to be able to raise prices, then you can invest in your business. You know that you've got some certainty of getting increasing revenue. Anyway, there we go. That's what's happening in Chinese markets. Yeah, but it's just worth considering. You know, it affects our markets. It really does. Certainly affects a lot of the Eurozone markets. Germany's car industry has been absolutely walloped by the significant decline in demand from China, not just for cars, heavy engineering, everything. UK markets, I've sort of touched on it. Who was that? That was another Paul. Yeah, I think they're just contending with the volatile oil price that's affecting our oil majors, which is reflecting the escalating war in the Middle East. And I think the budget dominates the press, as I said, with speculation about what taxes are going to be raised and what the impact will be. And I think most fund managers just know, and again, going back to this chart, that they just have to wait until they know what the news is, what decisions have been made. So they're all sitting on their hands. And I think one thing is clear, that international investors are sensitive, or overly sensitive, I should say, to any increased borrowing, any sort of messing around with the classification of borrowing. And that's however it might be dressed up as. So That's you could actually see it. So some of the borrowing costs have started to rise. The bond or gilt yields. Have a quick look. Just having a look at a bit of market data on the FT, and we can look at bonds, and you can see where the change. There's been a bit of a jump. So this graph, we're looking at, say, 5-year bond yields. So higher yields, not good. It basically means the government's going to have to pay more for its borrowing. A month ago, the 5-year yield was 3.65. It is now 4.08. Last week it was 4.14, so it's sort of slipped a little bit in the last week. But over the last month, borrowing costs have gone up. And I was listening to the radio last night. Was it the chief executive of Lloyd's was saying that mortgage rates weren't going to go down to the lows that we've been used to over the last 10 years. Let's talk about stating the obvious, but I wonder whether people think, oh well, let's have them back down at 2% again. Any one of us, I think most of the people in this webinar, surely we remember interest rates, don't we? Who paid 12% on their mortgage? Hands up. I did back in 87, 86. Post, I remember Norman Lamont shoving interest rates up. Come on, anyone confess to paying more than I did for their mortgage? 15%. Michael's raised me. Anyone at 17? Paul? Yeah, actually, I think it did get to 17, didn't it? When Lamont went nuts trying to defend the pound. Yeah. Yeah, Maureen. Maureen, you have avoided it, did you? Gosh. Yeah. I remember when John Charcoal offered me a fixed deal at 12%. I bit their arm off. I couldn't believe it. 12%. Fantastic. Do you remember all that MIRAS as well? Mortgage interest rate relief at source. Gosh. And you could get, if there were two of you, you could both get it. Yeah. Good old days, eh? The good old days. Anyway, let's get on. Onto the dollar. Just quickly have a look at what's going on in the dollar. Pretty quiet, really. You can look at the dollar index, sums it up. If you look at the dollar, just really flat last week. Still strong, still meant it's consolidated its gains. That's a very good description. But certainly it felt like a quieter week last week, following that sharp rebound. So we've seen this big jump in the US dollar, basically down to the fact that there was a lot of expectations that the Federal Reserve might be cutting rates again by 0.5%, having cut them for 0.5% for their first rate cut since the pandemic. And this is the market saying, no, it ain't happening. No, it's going to be a 0.25 point cut. And expectations have been certainly cooled a little bit further out next year as well. And that's, as I said, that's reflected in the stronger dollar. Commodities, well, I know we've been looking at the snipers on both UK and US oil. Oil was, about $1 higher last week, just reflecting the war between Israel and Hezbollah. That's sort of intensifying a little bit. And this report that suggests that Israel is close to retaliating against Iran for that recent missile barrage directed at it by Iran. You just don't know what it's going to be. Hopefully it's not going to be the oil infrastructure, which would just send oil sky high. And that's not something that Biden or Kamala Harris, more to the point, is going to be keen to see happen. Gold, I don't know about sniper brewing there as well. Gold, it sort of reflects the unstable global macro picture, really. You've got Russia and Ukraine, you've got Israel and Gaza and Israel and Lebanon and Hezbollah, and you've also got the Houthis as well in Yemen. So it's sort of proxy war, isn't it? It's but the real player is Iran, obviously, that funds both, all three of them, in fact, the Houthis, Hamas, and Hezbollah. Let's get on to the calendar quickly. Quite a few bits of data coming out this week. We got inflation in the UK. We've got ECB policy meeting, expecting a rate cut there, and some retail sales. Yeah, so a little bit to talk about. It'd be even better if I went on to the right month. US troops, it's Yeah, I think they're very reluctant. The problem is there's THAAD missile batteries. It needs a lot of personnel to manage them, and they need to be trained. I just don't think it can happen in time. But yeah, Michael says that uh, the US are having to send 100 troops on the ground, boots on the ground, they call it. But they're not actually in a war zone. They're in Israel, um, manning these batteries of THAAD missiles that can take out high altitude ballistic missiles. Yeah. Okay. Well, we've already discussed the CPI data that came out on Sunday. It is a bank holiday in Japan. If you're interested, it is Health and Fitness Day. Yes, they have a bank holiday for health and fitness, and the Japanese markets were closed for it. Um, it's also a holiday in the United States, and you can see that here. But the stock markets are not shut. Stock markets are not shut. All that is closed are the bond markets. So the bond markets are closed, but you don't probably trade the bond markets. I don't. No problem, Maureen. You have a good rest of the day. I'll finish in a second anyway. So what else is happening Monday? Oh, yes, we got this international. You too. Yeah. And Canada. Yeah, it's bank holiday in Canada, but I think their markets aren't shut either. They always have the same holidays as the US. It's like, I suppose they just want to. They also have their, you know, employment data out at the same time, don't they? And other things. Yeah. Um, so what was I going to say? Yeah, we got this chap Waller, Christopher Waller. I don't normally. We have so many people speaking throughout the week. I don't tend to focus on too many, but Christopher Waller, he's actually speaking about the economic outlook at Stanford, which that's got to be interesting, hasn't it? I'd say. So dollar and dollar assets will be quite interested to hear what he's got to say. If he does, if indeed he does says something that's contentious, um, but that's Monday. Tuesday we've got this our UK employment data, so it's called the claimant count, the number of people claiming unemployment data. The jobs market has been slowing, jobs growth have been slowing, along with average hourly earnings as well, which is something that the MPC will be quite pleased to see. But there are concerns actually amongst the MPC about wage settlements that are happening now, and the fact that all these wage settlements are starting from a higher base, which can be inflationary. Anyway, UK assets and sterling will be sensitive to that data. We've then got this German economic sentiment indicator, which is a survey of institutional investors and analysts and economists, and been on the decline since mid-year. Yeah, it's not surprising actually. Germany is not having a great time of it with sort of structural problems in Germany, and they've got cost base is a lot higher, and they're struggling to recover from a significant fall in demand from China. And I think one of the reports I heard was that VW was considering closing one of its German plants, which is something that has never ever happened before. One or two of them, I think. Yeah. Anyway, the euro will be sensitive to that data. Empire State Manufacturing. This is the New York State. There are two big manufacturing bases. The New York State is huge, and there's a lot of manufacturing in it, especially in the north. It's the first respectable month number last month. Would you remember that? 11. Well, you may not remember, but 11.5%. That was the best month for a long, long time. But looks like it's going to be reversed. 3.4 expected this time round. And then we jump to the inflation data coming out 7 o'clock tomorrow morning. So consumer price index. We're expecting a fall, quite a fall from 2.2 to 1.9%. The Bank of England's target is 2%. Price pressures have eased further. That's what we've been told. And it's a key number, a very key number ahead of the monetary policy committee meeting, the MPC meeting in November. And the overnight swaps markets are implying a 75% probability of a quarter point cut in November and a 60% chance of a further quarter point cut in December. I think it really does hinge on the scale of this this CPI reading, certainly for projections for December anyway. But I think we're likely to get at least one cut before the year end, that's for sure. Christine Lagarde, of the chairperson of the European Central Bank, she's speaking in Ljubljana. Anyway, with the ECB meeting the following day on Thursday, I can't think she's going to be saying anything that the market will be vaguely interested in. I'm not sure why that's plastered up there. And then on Thursday, yep, here it is, the European Central Bank Governing Council meeting where they set interest rates. And it's all been a bit weird ahead of this meeting. There's been very, very little guidance on what is going to happen, what they're going to cut by. And the market basically has decided, with growth stalling, with inflation definitely falling, that the European Central Bank will be cutting by 0.25% from 3.65 to 3.4, as highlighted there. Yeah. There is a press conference as well afterwards at 1:45. Yeah, there it is, 1:45. Could be interesting. Yep. I'm not sure there's a Q&A session, but there is a press conference when we'll get more data, more feedback. Maybe a bit of guidance would be helpful. So that's at 1:45 UK time. That is UK time. And then then I have to jump now to, where's my retail sales? Oh, it's before. Yeah, that's a good point. The retail sales, it slots in between the announcement of the interest rate change and then the press conference. I was wondering where it's gone. We've got retail sales out in the United States. Headline expected at plus 0.3%. That's the one highlighted there. And the core, the one that excludes food and energy, at plus 0.1%. Ahead of the FOMC meeting on the 7th of November, I think the market is more at risk of a strong number. So if retail sales or core retail sales is much stronger than expected, say plus 0.3%, I think that could start to impact rate expectations, certainly for December anyway. So I think the risk is on the downside there. But the dollar is sensitive to that data and UK assets as well. Sorry, US assets, not UK assets. And then Friday, talking of UK assets, UK retail sales. We're expecting a decline of minus 0.3%. Had quite a decent number in for August that was published in September, 1%. And it's been very choppy. Look at the graph. Just chopping all over the place. So, and it's, I don't know, being a retailer, what a nightmare. Just one good month, one bad month, one good month. And I don't think it's anything to do with the collection of the data. I just think weather has a big impact on our behavior as far as spending is concerned. But there we go. That's retail sales here in the UK. Sterling will be sensitive to that one as well. Yeah. Good. Thank you very much for listening. 9:15, a bit not too late. Has gone on till 9:30, especially when Stuart hands over at 9 o'clock. Thank you very much for listening. Thank you very much for attending. Any other questions? Anyone want to know anything about the world? What's going on? Hopefully I've told you. No? Okay, good. Well, listen, have a good rest of the day. No problem, Josie. Edward, you have a great rest of the day. Paul, 2 Pauls. Michael, yeah. John, all the best. Have a good one. And we'll catch up again 8 a.m. next Monday. Bye for now.